What's going on, everybody? This is Coach Wade, and today I want to talk about a strategy that you've probably heard mentioned if you've spent any time learning about investing. It's called the three-fund portfolio. Now, don't let the name intimidate you. Despite how official it sounds, it's actually one of the simplest investment strategies you'll ever learn. In fact, one of the biggest lessons I've learned over the years is this: sometimes simple wins. A lot of people think successful investing has to be complicated. They think they need to own 50 different mutual funds, buy individual stocks, watch financial news every day, or constantly move money around trying to beat the market. But many long-term investors have discovered that keeping things simple can make it easier to stay disciplined. So, what is a three-fund portfolio? Just like the name suggests, it's an investment portfolio built around three broad index funds. Typically, those three funds are a total U.S. stock market index fund, an international stock index fund, and a bond index fund. That's it. Three funds, three different parts of the investment world working together. Now, let's talk about why each one is included. First, the total U.S. stock market index fund. This gives you ownership in thousands of publicly traded companies across the United States. Large companies, medium-sized companies, smaller companies. Instead of trying to guess which company will be the next big winner, you're investing across much of the U.S. stock market. You're giving yourself broad diversification with one investment. Next, the International Stock Index Fund. Remember what we talked about in our last lesson. Great businesses don't only exist in the United States. There are successful companies all around the world. An international index fund gives you exposure to companies located outside the U.S. That means your portfolio isn't dependent on just one country's economy. It adds another layer of diversification. Then we have the third piece, the bond index fund. This is the part that often helps balance the portfolio. While stocks are generally focused on long-term growth, bonds have historically played a different role in many investment portfolios. Many investors include bonds as part of their overall asset allocation to help manage risk and provide diversification. Again, that doesn't mean bonds are risk-free. No investment is, but they often serve a different purpose than stocks. Now, here's something important. You'll notice I haven't told you exactly what percentage should go into each fund. Why? Because there isn't one allocation that's right for everyone. Your investment mix depends on several things: your age, your financial goals, how many years you have until retirement, your comfort level with market ups and downs, and your overall financial plan. For example, someone who is 25 years old and just beginning to invest may choose a different allocation than someone who plans to retire in 5 years. Neither approach is automatically right or wrong. They're simply designed for different situations. That's why it's important to understand your own goals before choosing an investment strategy. Now, here's another reason people like the three-fund portfolio. It's easy to manage. Instead of trying to keep up with dozens of investments, you're monitoring just three broad funds. That simplicity helps many investors avoid one of the biggest mistakes in investing: overcomplicating everything. Here's something else I want you to think about. Many people spend more time researching the next investment than they do actually investing. They watch YouTube videos every day, read articles after article, listen to every financial expert, and months go by, sometimes years, without ever getting started. Eventually, research becomes procrastination. Learning is important, but at some point, you have to develop a plan and stay committed to it. Now let's talk about rebalancing for a moment. Over time, one part of your portfolio may grow faster than another. For example, if stocks perform really well, they may become a larger percentage of your portfolio than you originally intended. Rebalancing simply means reviewing your portfolio periodically and adjusting it back toward your intended allocation when appropriate. It's one way some investors maintain the level of diversification and risk they originally planned for. Now remember, the three-fund portfolio isn't about chasing the hottest investment. It's not about predicting which country will perform best next year. It's not about finding the next big stock. It's about owning broad sections of the investment market, keeping costs relatively low, remaining diversified, and staying focused on the long term. As I teach in stage 4 of the 7 stages to financial independence, the wealth building zone, the goal isn't simply to invest. The goal is to invest consistently. I encourage people to work toward investing 15% of the household income for retirement. Not because one investment guarantees success, but because consistently investing over many years gives your money time to grow. And time is one of the greatest advantages an investor has. Here's what I want you to remember. A 3-fund portfolio is built around 3 broad investment categories: a total U.S. stock market index fund, an international stock index fund, and a bond index fund. Together, they provide broad diversification across different markets and asset classes. The exact mix depends on your personal goals, time horizon, and investment strategy. The important thing isn't having the perfect portfolio. The important thing is having a thoughtful plan, understanding what you own, and staying disciplined enough to stick with it. I'm Coach Wade, and I believe investing doesn't have to be complicated. You don't have to own dozens of funds. You don't have to predict the future. You don't have to chase every new investment trend. You simply need a solid plan, the discipline to keep investing, and the patience to let time do what it does best. Because wealth isn't usually built through complexity. It's built through consistency. One investment, one contribution, one good financial decision at a time. I'll see you in the next lesson.